Hi, Colin Healey here from Premier American Uranium. Been with the company since March of 2024. Previously, uranium sector analyst and equity analyst for 16 years in the industry.
Troy Boisjoli, CEO of ATHA Energy Corp. ATHA is a large-scale exploration company in the uranium space across Canada, with a large and growing deposit in Nunavut.
Guys, thanks for coming on. In fact, Colin, you're just the man to start with, because I think the big question on everyone's lips are, what is happening with the equity prices? Is there a disconnect in the market, or is it just a moment in time and we need to have patience?
I think it's a bit of both. I think there is a disconnect in the market, specifically between the unbelievable fundamentals in the uranium sector and the uranium spot price and uranium term price. The majority of uranium is purchased by utilities in the term market. Term price is holding at $80 at month end here, according to UXC, and the spot price is $65. And I think that is a perceived disconnect. Historically, the discount between spot generally trades at a 10 to 15% discount to term price, and I think it's not abnormal to see spot below term. It typically induces an attractive carry trade where you can contract with utilities for future delivery and buy in the spot market and hold. I think that trade has been, somewhat absent from the market, and I think that we have a setup here where we could start to see a firming up of spot price. And one of the drivers of that is going to be the return of the carry trade. In terms of equity valuations, another disconnect in my view. Uranium this time last year, right around this time, we were $107. Now we're 65-ish, and the ramp up in pricing was extremely quick, and there was a correction, which is very typical of the uranium market. But I think that we'll start to rebuild now that term price is holding. Term price has been up over 20% in every year in the last 4 years. And I think that that's where uranium investors should look when they're looking at making uranium investments. That's what's going to determine what price utilities can buy the majority of the uranium at and what producers can sell at. So, the spot market does tend to influence the equities. But I think it's undue or excess influence, and that we really need to remember where the term price sits and how the fundamentals are.
And what about you, Troy? I mean, as a uranium investor myself, am I being a little bit greedy? I mean, the last 3 years have been good to me. Should I expect moments like this?
I guess so, right? No one wants to see moments like this, but certainly, there has been a very strong pullback on the equity space that has resulted in, as Colin was touching on, the spot price coming off, etc. With us inside the industry, we like to talk about the spot price doesn't matter. Fundamentally it doesn't when you look long term, etc. But from an equities market perspective, it's not the only thing that matters, but it might matter more than all other things kind of put together, if you want to put it that way. And so, I do. It does matter. It does matter as it relates to the equities markets. And the way I view it, and our view as to where we're at right now, is we're seeing a return, and we're seeing higher contracting volumes, I think, in January of this year than we've seen. And when you look at uranium across cycles, as Colin mentioned, it is true that spot price typically trends lower or trades lower than term price. Except when you see periods of high contracting going over replacement rate contracting. And then you get, that carry trade turns into speculation, etc. For example, think about 2006, 2007, 2008. The run up into a big contracting cycle, spot price of uranium absolutely shot up, took off as a function primarily of that contracting cycle. So that's what we see on the horizon.
Okay, so I'll come back to you, Colin, on this one. Obviously, Troy's said, look, spot is important because it drives, I guess, sentiment. And sentiment in a kind of small space like this, where retail are the kind of big drivers for a lot of the uranium companies at the moment, that's the focus. But on the other hand, as Troy says, people in the industry don't look at it like this. But it's a delicate little dance going on at the moment.
It is, and I think that that's one of the reasons that I mentioned the potential return of the carry trade. because spot definitely has influence on the equities. We talk about leverage to uranium prices, and in general, the more volatile price is the one that we think about when we think about leverage in our equities to uranium price. So, talking about that carry trade is really me talking about one of the reasons that I think that the spot price could start to firm up, put in a bottom, and even close that gap on term price. The bigger the gap between spot and term, the more attractive that carry trade becomes. So there are reasons good functional, historically supportable reasons that you could start to see a rebuilding in spot price here, as long as term price holds. But yeah, I would never say that there isn't a correlation between the equities and the spot price. I think what Troy is saying and what I also suggests is that maybe it shouldn't be as strong as it is, but it always will be, and it's something that we have to deal with. I think ultimately, though, the fundamentals prevail. Troy touched on it. I think U.S. utility contracting in 2024, 30 million pounds was like 50% more than in 2023, but way below replacement rate. So over a long period of time, they should average something closer to 47, 50 million pounds of contracting, as they kind of fulfill their needs. Those deliveries are spread over several years, but on average, you need to be contracting every year for your requirements. And so I think that there's still, I talked about in 2023 when U.S. utilities were, just 20 million pounds of contracting out of 160 in the market, that they were probably sitting on the sidelines a bit, trying to figure out, where conversion and enrichment was going to happen. They were waiting to see what the ban on Russian low enriched uranium imports how it was going to impact them. So there's a whole bunch of reasons why maybe contracting was suppressed. And like Troy said, in 2025, I think U.S. Utility contracting is already at 50% of 2024 levels. So there's definitely potential for significant increase in contracting this year, and I think we're starting to see it.
Right, and let's talk about this kind of. I don't want to get into a conversation about demand, because I think whichever way you look at it, the demand is there. And I think the thesis is well understood in terms of structural uranium deficit from that perspective. But do you feel that investors have kind of got bored, frustrated, disinterested, or maybe there's more shiny new objects elsewhere where they're deploying their capital? And that applies to retail and institutional. What do you reckon, Troy?
Hey, I think probably a little bit of all of the above, if I'm honest, right? That you see that across the board. But the way we look at this is, everyone knows the demand side, the structural deficit, et cetera, et cetera. And it's like, well, when is it going to come to fruition? But it's important. Like that is a very important part of the story, and that's why Colin and I are sitting here. Is that is a real structural deficit in this market, and one that needs to be filled, and one that doesn't have a clear line of sight to how that's going to get filled on the supply side. Okay, and so that's why we're building what we're building. That's why we have assets under management that we're advancing through this cycle, is to build that real true fundamental value that is going to be like a coiled spring, and coiling that spring tighter for when these near-term indicators return back to the space, when we see uptick in spot price, when we see further pressure higher on term price because of replacement rate contracting levels, et cetera, et cetera. And so from ATHA's perspective, that we're heads down. We believe full stop in this cycle, in the longevity and robustness of the cycle, and we believe that it needs real assets to help solve a supply demand challenge that we're running into headlong. So that's how we're responding.
Okay, well, we'll come on to the supply component in a minute, and then talk about real assets in a second. But and I'm going to come back to you, Colin, because as an ex kind of finance guy, is this the case of companies having to rebuild confidence for retail investors, or, as you say, is it let's just point to the things which really matter and stop with all of this catalyst moment conversations which we've seen? I think we're possibly have damaged ourselves in the last 4 or 5 years, claiming the next thing is the next big thing. What do we do in terms of telling that story? You're not saying bet your house on this. You're saying, it belongs somewhere in your portfolio because the thesis holds true. Is that right?
Well, definitely. I think that's right. In terms of catalysts, if you're thinking of kind of the catalysts that we talk about from from the perspective of running companies and delivering catalysts, I mean, it's been extremely frustrating to deliver catalysts into a market that doesn't appreciate them, because as Troy kind of mentioned or alluded to before, the movement of the stocks is being dominated by spot price, right? So you can do a lot of things to de-risk your asset, deliver great results. Our Cebieta project in New Mexico in June, we delivered way ahead of schedule, 23.5 million pound resource, 80% in the indicated category. And those are big accomplishments that aren't easy to make happen. And it's indicative of a good management team, and it's been super frustrating to see those kind of not necessarily move the stocks. But I think that, I know we're going to talk about supply. I think the demand side is extremely well understood, but I mean, there's so many strong catalysts on the supply side that suggest that uranium prices should be higher, that there's more risk in supply than we ever think about. So I'm not sure if that really answers your question about catalysts.
I was coming at more from the point of view as kind of like the boy who cried wolf scenario in the marketplace, not from the companies themselves. Well, maybe occasionally the companies themselves, but let's say catalysts come and go, and you've achieved a lot, but it's not necessarily rewarded. But when you've got people out there calling for, $200 uranium tomorrow because something's happened somewhere in the world, it doesn't help. It makes it harder to retain trust, I think, with retail. That's where I was going with that.
Right. And that kind of rhetoric, I mean, it's really, really hard to call uranium prices. If you look at historic uranium charts, you're talking a little bit about how the stocks trade, and we have a template, many years of history of how uranium stocks trade. So when uranium prices go to $107 and uranium equities respond substantially, there's a natural tendency to take profit, pull back, and wait for a bottom. But there's momentum to that, right? So you do get situations where equities get oversold, and there's an opportunity for people who believe in the fundamentals to get in much, much cheaper, at times like this. But it is hard when you've got some very, very strong believers putting out numbers, sometimes extremely, optimistic, or maybe optimistic on short time frames. When those things don't come to fruition, it doesn't help the sector, and it does take away from the, fundamental supply imbalance. We've been at 80% or less on the supply side of global demand since 2018. We're perpetually undersupplied, and that has a lot to do with the inventory that we built up post Fukushima. But that doesn't change the fact that slowly we're putting that inventory into places where it's not that liquid, or we're consuming it, and at some point there's going to be a squeeze, and we're going to see much higher prices for a long period of time. WNA thinks that well, I don't want to talk about supply yet if you don't want to talk about supply yet.
No, let's go there. Because it's a kind of holistic conversation. This
Troy looks like you might want to jump in. Happy to let him do it, but I've got always lots to say. Troy, did you want to pitch in on that?
Yeah, no, I agree, Colin. It is a for years, I think, as we're all aware, for years in the uranium space, it was never really a supply side story. It was always about demand, and that same time frame that Colin's talking about, where we have had a perpetually undersupplied uranium market, that's when we started to see real demand being built, right? It was a period post Fukushima. Then you started to see demand layering on, and now demand is not the risk. Demand's on the robust side of this story, and it really comes down to supply. And on the supply side, then you start to think about, well, what does the incremental incentive price of uranium need to be to incent that incremental amount of production to close a supply demand gap? And it's not $65, it's not $70, it's somewhere substantially north of there that is required, and that's where this market, in our view, that's where it's going to push towards. And one of the near-term things is that I think is very, very important in a uranium cycle, when you look back historically, is, again, it's supply, but then it's on contracting. Yeah, and when you start to see a return to replacement rate contracting or above, you see that correlated to upward pressure on the spot price as well. So those are the things in the near term I think are important.
Right. Well, let's talk. Let's kind of head towards supply, and it's really about look. This is a small space. Uranium is a small space. Not that many companies. Certainly not that many producers, and the ones that are there, obviously, care and maintenance, flooding issues, technical issues across the board, and production issues, even if they do get there. The type of people available are going to be important to building successful companies. The asset itself is important, and these sorts of fundamental drivers are the things that we look for, rather than a pure marketing play and a participant award play, which we see all too often. So. Again, Troy, just stick with you for a second on this one. Like your Cameco background, very, very much in terms of understanding, finding economic pounds on the ground, and then moving these things towards production. It takes a lot longer than we think, and there are lots of issues. We've seen it happen in other less complicated metals, and this one is a very technical metal. It's going to be problematic. So perhaps there won't be as many pounds as we think.
Matt, as you mentioned, I was fortunate enough early in my career to come up through Cameco, that then had the opportunity to help drive a project forward in the Rook 1 project at NextGen. As you mentioned, there's a lot of moving parts to building, developing, operating, and executing on a uranium mine, especially a large scale, operation or conventional uranium operation. And it does take time, and it takes people, it takes access to capital. It takes a management team that has experience to manage through pullbacks or stages of capitulation within the market, and come out of it strong and be able to add value at these times that shareholders are going to get to take advantage of down the track. But as it relates to actual supply, when Colin and I both, kind of hands in the middle of the table say this is a supply side story because there is supply side risk, that's because that is exactly what it is. You look at having to balance a market with, tens of millions of new pounds of production coming in that haven't been built, that aren't operating, etc. You think about timing risk as it relates to that. You think about execution risk, etc. And then you have aging assets. The existing assets, you look across the largest production centers in the world, and you have assets that are looking at decline rates from here out to the 2035s, right? Across the Athabasca Basin, you look at assets that are looking at being at the tail end, not at the start of their production history, of their production life. Well, you take those two biggest centers and you combine them and you look at it, that is supply side risk.
And what happens to, and Colin, for you, as ex-market guy as well, what happens when there are problems in the space? Like, 2 quarters ago, Paladin had a wobble, shall we say, and that kind of sent reverberations around the marketplace. It's the poster child, supposedly for the space, yet it experienced problems. You've got Kazatomprom experiencing difficulty with projecting out pounds. They're in severe decline. It seems Cameco as well. They're being very, very cautious about this. It's not necessarily a good look for the space, but at the same time, these kind of depleting pounds into a high demand environment, what should that do for the market, and when do they start paying attention?
Yeah, I honestly think that there's a level of complacency there. The investors in uranium stocks for the moment seem to be very kind of short-term focused. So it looks more like trading than long-term fundamental investing across a lot of the sector. There still seems to be support for some of the biggest names. That makes sense for liquidity and scale reasons. But I think that by 2040, WNA says we're going to need 300 million pounds of production. That's a doubling. I know it sounds like a long way out, but as Troy alluded to, and Cameco on their quarterly conference call last week said, Cigar is scheduled to be depleted by 2036, and there's a few mines out there that will probably replace some of that lost supply. But the reality is that doesn't get us to a doubling that doesn't add 150 million pounds of supply by 2040. And if that's the reality, and don't forget, like when everybody, including Camco and most of us, when we talk about the demand side of things, we're talking about the demand that we have visibility right now, not the potential upside of all these other kind of renaissance type things. Like big SMR demand is not really in the demand side picture and doesn't need to be. We're still in this serious supply deficit that hasn't materialized in pricing yet, in my opinion. And I just don't see a market prepared to supply twice as much uranium as we are now by 2040. And, higher prices will help accelerate that. I mean, in the U.S., Premier's U.S. focus, and we're getting incredible kind of support from new initiatives from the White House. The NRC chairman says that he's going to approve new reactors in 1 year. They want to streamline the process for producing minerals, unleashing U.S. mineral dominance. All these things add up to supporting our thesis that we should be investing in the U.S. and developing assets that can be in production in the future. But I just think there's a level of complacency in the market. It's not looking far enough ahead to really kind of underscore why you need to invest now. And the types of shortfalls that we're going to see could push prices, incredibly high.
And I guess sticking with you, Colin, on this one. When I look at some of the finance, the hedge funds and fund managers out there looking at energy more broadly, there's a lot of optionality on the table for them. They can put their money where they want. What's the investment case for uranium companies, not the nuclear downstream companies? Why should they be buying up uranium mining operations?
I mean, specifically because the market's undersupplied and the price is going to go up. I mean, that's the reason to invest. That's the reason companies should invest in uranium mines. That's the reason investors should invest in uranium stocks. There's not too many commodities where you can very kind of, let's say, accurately lay out what consumption is going to be of that commodity. I always say demand for uranium is the most inelastic I've seen in any commodity. Utilities don't purchase more uranium at low prices. They don't purchase less at high prices. They just purchase, because the most important thing in running a nuclear plant is having supply. So you can lay out a very clear picture of demand, without layering on a bunch of upside for some of these other technologies or acceleration that I actually think that we're seeing, and still be quite confident that demand's going to be there for your product. And when you look at the supply side, it's really clear that there's going to be, it's not clear where supply is going to come from if some of these assets don't get developed. And as Troy kind of alluded to before, you need incentive prices to do that. So I'm hoping it happens in a more linear way than it has in the past, so that we can kind of plan and make investment decisions and be there with the supply as needed. That's ideal, but historically it's been volatile. So I'm expecting lots of opportunity to make money, especially, when you're coming into uranium stocks at these levels.
Are you excited about sort of seeing, I think it was a FT article last week talking about nuclear groups raising 1.5 billion to power the AI boom, but what none of them done from, I think we're talking about X Energy and Jane Street and various kind of US groups, Blue Energy, Last Energy, etc. None of them have actually secured anything to feed into these big investments, these downstream investments of theirs. Is that going to surprise you, the lack of knowledge, but the huge access to capital that these guys have?
I don't think that is surprising. It might seem from our side of the business to be surprising, but they're focused on stuff much further downstream, and as that materializes, the reality is going to hit that they have to come very much upstream in that supply chain and secure pounds. And that securing of pounds. Again, the uranium space and nuclear space is so interesting because I think about it in a way, Matt, that is, you look at other commodities and you need a number of things to happen. You need, EV rates to hit, sales rates to penetrate the market at a certain percentage, et cetera, right? Other commodities are intrinsically tied to, how much steel is being produced out of China, et cetera. Okay. Colin mentioned it. Uranium is, it's inelastic, and you're building you can project this out a long time in the future and have a very good understanding of where this demand side is going, because it's based off large scale civil nuclear reactors that are being built, that are being planned, that are in construction, that are in various stages of permitting, etc. So when you look forward at the demand side in uranium and you say it's robust, well, it's not. That's not relying upon a number of things that could potentially happen. These are things that are in progress, and this is directionally where we're going. And then you couple that with the supply side and this market volatility and uncertainty, particularly in the equity markets that we're seeing right now. What it's doing is it is functionally right now, it is pushing future supply out. When companies if companies don't have access to capital, don't have confidence in being able to execute and move things forward, that's just making things worse, because this is a perpetuation then of a supply gap. Because, hey, in the commodity space, the core of the demand and the core of the supply is going to be met by large players. It's going to be met by the incumbents. There's no question. But when you look at the amount of production or the amount of supply required to solve the incremental supply-demand gap, that comes from groups outside of the majors, right? Outside of the incumbents. And that requires investment in periods like we have right now to actually meet the gaps that exist in 2029, 2030, 2031, 2035, etc. So yeah, it's important.
Okay, so and what about just playing a bit of devil's advocate, kind of throwing in here, I'm trying to think why people might be concerned, but the US is obviously in a bipartisan way, adopting nuclear, or sort of doubling down on nuclear in a way which didn't seem possible maybe 4 or 5 years ago. But you've got non-proliferation treaty potential between China, Russia, US, where we're kind of recycling, nuclear warheads. Potentially. We've seen that before after the end of the Cold War. We're seeing maybe a flooding of uranium from all these Canadian companies, Troy. These things may spoil the party somewhat. I mean, how do you read that situation, Troy?
First of all, on the flooding of uranium from a bunch of Canadian companies, it's baked in, Matt. That is not supply that's flooding the market. That is supply that is needed to come online to even start to balance this market or get close to a supply demand balance. Absolutely required in this decade and then out to the next. And you think about Denison, good news out of their camp this week. They got a hearing date towards the end of October or mid-October, whatever the date is this year. They got a hearing date. I know the Ruppelmont project is waiting on a hearing date. Expect that kind of somewhere in the same timeline. Then you get into execution and production, and those things. Those are very confident, very capable groups, etc. But it takes time and it takes expertise to get that online. And we're talking a market that needs to be balanced. That's counting on those pounds coming to a market with a very, very small margin of error within months, right? And hey, so market's already counting on that. Is absolutely counting on those pounds coming to the market. And then on the proliferation side, I think we're a long ways from that. And hey, it's certainly something to keep an eye on. I think we're a long ways from that. And if it does come about, how many? Yeah, there's a lot of moving parts there right now. And I'm not concerned about it. I think we're a long ways off from anything like a megatons to megawatts program 2.0.
Right. Okay. But what about rolling back of Russian export bans and things like that? Where does that put us, both on the uranium and the enrichment side?
Well, and Russia's a net importer of uranium. So when we're talking about U3O8 supply, I think their reactors consume something like 60 million pounds domestic uranium mines in Russia, which we saw one of them having issues just this week with flooding, is around 6 or 7 million pounds. So they are a substantial component of conversion and enrichment costs. I think conversion costs were in the $18 range in February of 2022 and, shot up to the $95 range by the middle of last month. They're starting to come down. And I think that talking spot conversion, same thing, similar scale changes happen in enrichment. Russia's extremely important in the fuel cycle, and that's something that the U.S. is going out of its way to address, that reliance. But if you were to return to a situation where Russia was available as a converter and enricher, I think you'd see those conversion and enrichment prices come down the same way they shot up. Uranium prices went from $44 to $65 today, hit 107 on the way, in between the initial beginning of the invasion of Ukraine and now. But nothing like the multiples that we saw in conversion and enrichment. And I've always kind of tried to highlight the fact that the Russian role in uranium in U.S. is much more geared towards the fuel cycle than it is to actual uranium U3O8 supply. So I'm really not as concerned from Troy and myself's seat as potential uranium producers. I'm not as concerned about Russia. I think for the greater good, specifically with us in the U.S. The U.S. has to prioritize energy independence. That you need to remove that risk of reliance in any way. They've got great uranium deposits. They're starting to ramp up some production, but there's no reason that they can't go back to a time similar to when they produced almost all their own uranium needs. There's no reason not to. And if you're worried about uranium being mined responsibly and sustainably, I think you have to take that into your own hands and do it properly, because you have that capability with your people, your deposits. So I think there's a responsibility to bring some of that production back home as well. I think you can rely on Canada to continue to supply the U.S. With responsible and sustainable mining practices, and some of the other friendly countries. But I just think that Russia, if you're a converter and enricher, it's a very important piece of the equation. From a uranium perspective, they were there before. I don't think that it's as important to the uranium price as it is to conversion and enrichment. I think we have evidence to support that.
Yeah, no, I agree, and I think the other thing that it would do or could do, Colin, is bring confidence and certainty, and a little bit of a return back to higher contracting rates. It's like, well, why did in a market that we're in, with the amount of pounds that are becoming uncovered, and in particular U.S. utilities chewing into inventory and inventory levels dropping, why didn't we see higher contracting volumes in 2024? And a large part of that, in our view, was a function of the uncertainty between U.S., Russia, midstream fuel cycle, conversion, enrichment, etc. And I think it has the potential just to return back to a bit of normalcy within the nuclear fuel space, and could have a positive impact on price, because you could see higher contracting volume.
But do you think this change from just in time mentality, because it's more efficient financially, will switch back to where it perhaps used to be a few decades ago, which is building up large inventories for moments like this? In peacetime, it's easy to look at the margin. When it's been as, let's say, unstable as it has in the past 4 years, do you think that psychology, that behavior will change? And what does that do for our industry?
You're thinking specifically about uranium production and inventory building?
Yeah.
I think it's very difficult in an open market to expect that to happen at current uranium prices. I mean, the problem goes back to inelasticity of demand, right? Each incremental pound beyond what's necessary can have a significant impact on uranium price, because it's not purchased because of that just in time mentality. It's not as abrupt as I'm kind of implying in my example, but it is difficult in a market where utilities believe that supply is going to be there, for them to go out and really think about strategic inventory building at prices that are high. So it's a tricky thing to have happen unless it's done by governments, creating strategic reserves. Inventory building on the utility side, I think that it just feels like there's a limit to what they'd be willing to do At $20 a pound uranium back in 2017, 18, nobody went out and bought 25 years of supply. They're just not that way incentivized, So I don't think inventory building is going to be a strategy of at least Western utilities. I think Asia might be different. I think 40% of the non-US term market volume was in a single contract in 2024 to China. So their inventory building is a significant strategy of the countries who have a lot of control over the individual utilities, I would say.
Okay, it's just another sort of angle coming at this supply part of this equation, right? Like I said, we're going to make the assumption that the demand is there. If the demand doesn't change today, there's more demand than there is supply. So on the supply side, where are the new pounds going to come from? Because if everyone produces like they say they're going to produce, we still haven't got enough. And my problem is I don't believe everyone who says they're going to produce will produce. Certainly not within the time frame. And if so, I'm asking the question, how does that get funded? Then we move on to, well, where's the new pounds come from? When you throw that into the equation, everything gets just that little bit tighter, which is great for the guys who can. What do you think? What do you think, Troy?
Yeah, no, I think that is kind of what you were alluding to with the strategic reserves, right? And I think the reality is that within our space, okay, you look historically, and Western utilities have never really had to think about, do we build up strategic reserves because of supply side risk, right? You think back to the last cycle. Called the last cycle starting 2005, 2006 in that time frame. What did we have in that period of time? We had uranium that was moving substantially higher, spot prices moving higher, high contracting volumes. You had excess inventory in the market, excess supply in the market, but we also had this country called Kazakhstan. You had Kazakhstan that was going from around 8 million pounds per annum, just building ISR fields like crazy, ramping up into the 70s million pounds per annum. And so it was just, hey, prices solve supply. Supply is going to come online. We don't have to worry about the supply side from a utility perspective. And there's always been uranium in the market. There's always been excess inventory, excess uranium in the market that there was access to. We often call that secondary supplies. You look at how secondary supplies are trending and graphing right now, and secondary supplies, largely being under 20%, historically over 20% in the market. Those secondary supplies are drying up. And if I was a utility, I would be doing a very deep dive on the supply side of this market, because I think there's risk there that isn't realized, that they don't see, that isn't realized because of the history of this uranium market, where they've never really had to, right? They've always had access to pounds. It is, how do we lock it in, over what term, etc. Spot versus, spot market versus term market, etc. And a balancing act that way. We are entering into a different period of time now. And, as it relates to the supply coming online, hey, if you add it all up and then say, if everyone delivers on time, and, at the rate in which they say they're going to produce at, we still don't have enough. And then you add in the additional demand that Colin was talking about earlier, that the blue sky that isn't yet captured in that 300 million pound per annum model. Germany, talking about like stopping the decommissioning of their reactors and starting about flipping them on again, potentially, right? Things like that come in. We're not prepared for it on the supply side. Just in our view, over the timelines that we're talking about, between now and 2040, we are not prepared for it and don't have the assets to bring online to meet the demand.
Well, look, gentlemen, I think we've kind of touched upon a lot of the topics of conversation for people to go away and think about, maybe even do a little bit of research on. But it's kind of clear, I think, if you're listening to this, the demand is there, the supply is not. And I think that's going to do great things for the companies who can show that they can move their projects forward. So maybe let's finish off on that one. Colin, 2025, what's it look like for you guys?
2025 should be a strong year for PUR. I mean, one of the things that we're kind of most proud of is in New Mexico, the first half of the year, advancing that asset within 12 months of getting that resource that I referred to earlier. We're going to have a resource update and a PEA out. We're targeting, we're saying early summer. We're going to do everything we can to make sure we hit that timeline. I think it's deliverable. So that, you talked about catalysts, or I talked about catalysts earlier. I think it's extremely important to show the market what that would look like as a mine concept and as a production operation, so that we can continue to justify and show the market why we're investing in it. So hopefully early summer resource update and PEA on that asset, and then we're permitted to drill at our Cyclone ISR project in Wyoming starting in July. So New Mexico news in the front end of the year, and pivoting to Wyoming for July to October should generate some good news for Premier American Uranium.
Fantastic. And Troy, what about you guys?
Hey, we have a lot going on, but I'll summarize it up with Angulac. We have a project, Angulac, 43 million pound resource base, wrapped in exploration or resource growth target around that last year with an upper bounds of 98 million pounds. In addition to that, we have, we're just getting going on that project, Matt. There is significant growth potential there. And this year is about unlocking the growth potential, increasing the scope, the scale of that project. You think about numbers like we're talking about. There are very few projects in North America that have the scale that we're unpicking at the early days here at Angulac.
Brilliant. Look, guys, and for everyone listening, watching, reading about this, okay, these are two companies, real teams, real plans, real assets. Do have a look. Appreciate your time today, gentlemen. Thank you very much.
Thank you.
Thanks, Matt. Thanks, Colin. Appreciate it.